All right, today we're going to do something kind of cool. We're going to give a company a full financial health checkup. We're not just looking at the headlines, we're going to check its vital signs and see if it's really as healthy as it seems. Let's get started. So, how can you really tell if a company is financially healthy or if it's secretly sick? It's a huge question, right? A company can look like an absolute rock star on the outside, but underneath it all, it could be struggling, totally weighed down by a mountain of debt. So, how do we find out the truth? Well, it turns out, just like a person, a company has vital signs, and we can check them. We're going to use two super simple but really powerful tests to see what's actually going on under the hood. So, yeah, time to put on our lab coats. Okay, first up is what I like to call the balance test. We're going to use something called the debt to equity ratio to see, is this company stable? Is it standing on its own 2 feet? Or is it kind of wobbly, leaning way too much on borrowed cash? Now, look, debt isn't automatically a bad thing, right? Companies use it all the time to grow, to expand. It's like fuel. The real question is all about balance. And this test, it's beautiful in its simplicity. We're just putting two things on a scale: everything the company owes versus everything the owners have actually put in. It's a straight up comparison of debt versus equity. And the math here couldn't be easier. You just take the company's total debt and you divide it by its total equity. That's it. The number you get is our first super important vital sign. Okay, so you get a number. What does it actually mean? Well, a ratio that's less than 1 is generally a good sign. It's less risky. It tells you the company relies more on its own money than on borrowed money. But if you see a ratio that's over 2, that could be a warning sign. It might mean the company is way too dependent on debt, which can make it pretty unstable if things go south. All right, test number 2. We're moving on to the breathing test. This one's all about checking if the company has enough, breathing room to handle its monthly bills, or if it's kind of gasping for air. See, it's one thing to have debt, but it's another thing to be able to afford the payments on that debt. That's what really matters. This ratio tells us exactly that. It compares the profit the company is making from its business to the interest it has to pay on its loans. The formula for this one is EBIT divided by interest expense. Now, I know what you're thinking. What on earth is EBIT? Don't worry, we're going to break that down right now. EBIT is just a fancy acronym for earnings before interest and taxes. The easiest way to think about it is this. It's the raw profit a company makes just from its main business, before it has to pay the taxman or its lenders. This is the perfect number for our breathing test because it shows us the cash that's available to cover those payments. So, what's a good score here? You want to see a higher number. Anything over 2.5 is considered pretty healthy. It means the company is earning more than 2.5 times what it needs for its interest payments. Lots of breathing room. But if you see a number below 1.5, whoa, that is a serious red flag. It means the company is cutting it way too close. Okay, enough with the theory, right? Let's get our hands dirty and actually analyze a patient. Let's meet ABC Manufacturing. We're going to run our two tests and give them a full diagnosis. All right, here's our patient's chart. We've got all the vital signs we need. Total debt, $2 million. Total equity, $3 million. Their EBIT, $500,000. And their annual interest expense is $100,000. Okay, we have the numbers. Let's run the tests. First, let's do the balance test. Remember the formula? Total debt divided by total equity. So that's $2 million divided by $3 million. And the result is 0.67. That is well below our safety threshold of 1. So what this tells us is that for every single dollar of its own money, ABC Manufacturing only has 67 cents of debt. That's a really stable, well-balanced company. Excellent start. Okay, now for that crucial breathing test. We're going to take their operating profit, their EBIT, of $500,000 and divide it by their interest expense of $100,000. And the result is 5, a nice round 5. That is a fantastic result. It's way, way above our healthy benchmark of 2.5. This tells us ABC Manufacturing is earning 5 times more than it needs to cover its interest payments. They've got tons of breathing room. So what's the final diagnosis, Doc? Well, based on our two tests, ABC Manufacturing has a clean bill of health. It's using debt smartly, it's not overstretched, and it can easily afford its payments. Honestly, it's a textbook example of a financially sound company. So our patient, ABC Manufacturing, is in great shape. But why does this little checkup even matter outside of this one example? What's the big takeaway here? Well, this kind of analysis is crucial for pretty much everyone. I mean, investors use it to spot risky companies, lenders use it to figure out if they're going to get their money back, business owners themselves use it to make smart decisions about borrowing. And for you, it's an awesome tool that lets you look past all the hype and see which companies are actually built to last. So there you have it. You now have the tools to do your own financial health checkup on any public company. The numbers are all out there, just waiting for you in their financial reports. So the only question left is, which company's health are you going to check first?
Disclaimer. Educational content only. Not SEBI registered. This is not a buy/sell recommendation. Invest at your own risk.